I want to hear your thoughts on challenger banks and if you've changed your mind or if what's going on now has sort of changed your thesis, what your thoughts are on that.
So full disclosure, we're investors in Acorns, which is similar to Dave. And I know the team at Acorns has high regard for the folks at Dave. I think challenger banks that are merely digital versions of checking accounts don't have that rosy a future. In general, we're kind of seeing this across financial services, that wave one of, hey, we lend you money, we'll insure your house, we'll do that same thing that incumbents do, but we'll do it with an app. That approach was reasonably successful, but I feel like those days are kind of over. Actually, JP Morgan Chase has a great app, BofA has a great app, and so I think you need something meaningfully different. And I think Dave has something meaningfully different. I think they have, beautiful software that people pay to use and then receive banking services in the context of that beautiful software. And the same is true directionally for Acorns. So I think that's still promising. I think consumers expect more, deserve more, and I think these apps give them more than a traditional bank. I think the unit economics are in the early days of being proven out. We just don't know if we can get the same kind of lifetime value per customer that banks traditionally have. It's not the case that if you go to Citibank and say, what's your most profitable line of business? They'll say, oh, it's the DDA business. We love checking accounts. It's not a good business. You do it to build customer relationships, and you do it to get cheap deposits that you can use to make loans. That's the business. And so to the extent to which really only regulated financial institutions can make money doing lending, then I think all of these neobanks have to be really thoughtful about their unit economics. I think subscriptions are a really smart way to do that. But how big a business can you build from consumer subscriptions is an open question. So I remain convinced that Americans will, to some degree, shift away from their banks. Probably not the top 4 banks who can spend money on great products, but the tail end of the 14,000 financial institutions who use whatever app FIS gives them are going to lose customers to Dave and Acorns. And then the real question will be, how valuable will those customers be for Dave and Acorns over time?
Can you see a way of some of them reinventing themselves to maybe provide some service that is more needed now? I mean, you mentioned SoFi, they completed an acquisition, but I guess they do have a bit of, not all of them, but they've now reached some sort of distribution that's not comparable to banks, obviously, but it's still bigger than someone starting now. So I don't know if they were your portfolio companies, what you would advise them to do.
I think there are 3 playbooks. The one that we've seen in a lot of lenders is to launch ancillary products, non-credit products, generally speaking, banking products. So a DDA, various payments products, wealth management. SoFi was sort of running that playbook until recently. And Moneyline is another, company that started life as a lender and has introduced a bunch of flanking products. Dave, who we just heard from, really invented this overdraft protection loan as sort of their first hook. And obviously, as you heard, now do much, much more than that. So I think that playbook 1 is, dilute the impact of lending on your P&L and your balance sheet by getting into truly ancillary businesses, all sold to the same customer. So sort of recreating the supermarket, if you will, in the way that JPMC and BofA and the majors all have. The second is to take your technology, which presumably allows for marketing to underwriting, account opening, servicing, collecting, that full suite of technology, and offer it to other lenders. So do a B2B pivot. We've seen lots of companies do that. On Deck did that. Upstart has done that. Avant did that. And I do think banks need better tech there's an open question as to whether they should buy tech from people who built it as vendors, like an Encino, for instance, or a Blend Labs, or buy it from folks who built technology for themselves and are kind of pivoting and repurposing it. I think there are some cautionary tales about that kind of repurposing. And the third thing, SoFi's recent move is just enter a wholly different business. I mean, it's a bold move. I'll give them credit for that. I do think that being an issuer processor like Galileo is a better business than being a student lender, but I'm not sure that the two have much to do with each other than being broadly defined as fintech. So that's always an option if you have massive amounts of equity with which to use in a pivot like that. Actually, there's a fourth thing you can do, which is what Lending Club was in the process of doing, which is actually buy a bank, which is in effect an acknowledgement that non-bank lending is not a great idea. And I thought that was incredibly smart. I hope the deal still goes through for them and they get that kind of permanent funding that they need. And I think that will make them a really interesting player in the space. So those would be the four strategies I would contemplate if I had invested in a lender in the last dozen years.
Did you get a sense of perhaps tech that these banks might be looking for, solutions that they might need that no one was building? Are there opportunities there no one has thought of? Would you kindly share them with everyone now?
Yes, exactly. There are areas of the banks which I think are structurally massively underinvested, and where fintech hasn't really gone in full force. I think loan servicing, one of those areas that we've been interested in, and now there's a handful of companies we could name. We invested in a company called Up last year that really focuses on communication and payments in the loan servicing space. But there are very few new vendors and talented, dynamic tech-forward vendors, Scratch and Peach and a few others. But that's an area that I think there will be a wave of demand as you have these customers asking for forbearance and loan modification at record levels. The servicing systems are under tremendous stress. And I think relatedly, collections. Collections has been this back office function that's been starved of resources. And there haven't been a dozen even fintech companies going after it. You have TrueAccord, you have Detsy, a really short list. And that's going to be an area where I think budgets are going to be expanding. So there's pockets of the bank that under times of stress receive more resource. Because we've had 10 years of good weather, those haven't been areas, frankly, that entrepreneurs have been particularly focused on. And I think it's a real opportunity for the scant number of fintechs that exist and for entrepreneurs to focus on that.